Hi friends, welcome to Power of Compounding. This is an important video for students or someone who started working and especially for the people who are confused about investment planning. Friends, I have wasted couple of years in my life just to realize the significance of investment. So when I got job and started working, I didn't even know about the investment options that are available in the market. Okay? Just because there is no proper guidance to me. I wish the amount of valuable time that I have wasted in my life should not happen in your case. So for this, I try to put all my experience and my learnings in this video. So I request you to watch till the end of this video. If this information can bring some difference in your investment career, then I'll be the happiest person for making this video. Alright, now let's get started. Friends, there are certain questions that you need to ask yourself before you think of investment. So I try to list down some of the important parameters that one should consider before they start investing. Okay, so let us try to understand one by one. So the first thing is investment goal. Okay, so friends, one should have a clear goal for what purpose they are investing. So let's suppose if I just started working, then I may set a goal to buy a bike with my salary. So that is something a short term goal where you can achieve in a 1 year or 2 year period of time, right? So similarly, if you want to buy some ornaments to your parents, that is something again a different type of goal. You want to buy a car, you want to construct a home. These all are goals, right? So before you start investing, you should have a clear idea on what purpose you are investing. Okay. And the next thing is investment time frame. So friends, so when you want to fulfill a investment goal that is set by you, you need to have some idea about the investment options, and also you should have knowledge on how much return that each entity can generate. Okay. So depends on the security that you invest in, the returns may vary, right? If you invest in FD, the amount of return that you get comparatively small when you invest in mutual funds or in equity, right? So the investment time frame is depends on the option that you have chosen where to invest. Okay. So I hope at the end of this video you will be having a clear idea on the investment time frame. Now the other thing is risk tolerance. Okay. So friends, it completely depends on the individual risk appetite. And the main important factor when it comes to risk tolerance is your age, friends. Okay. Your current age can define how much risk you can take. Let's suppose a 50-year-old person may not be able to take the same risk as a 25-year-old person takes, right? Because a 25-year-old person is far away from the retirement, so he can take certain amount of risk in his investments, right? So age is something a very important factor that decides the amount of risk that you can take. And the next important thing is asset allocation. So friends, so allocating your funds is completely depends on the above three factors that what we have discussed. It depends on the goal that you set, and it depends on the time that you targeted for, and also it depends on the amount of risk that you take. Okay. So the best thing about your asset allocation is diversifying your investments. If I want to achieve some big goal in a less time frame, then I might invest in an instrument where risk is involved, right? So your funds allocation is completely depends on the above three factors. And the last important thing is emergency fund, friends. So many of us neglect this, but we should be very careful about our emergency fund. So sometimes there might be some unexpected medical emergency, or there might be some damage to your vehicles. So these are certain things which you didn't plan, right? So to stay in a safe zone in all these different conditions, one should maintain some emergency fund. At least it should be your 1 month salary. Okay, that's the importance of an emergency fund, friends. So I hope you understood all the above five factors that one should consider before you invest into any entity. So try to analyze each and every parameter whatever we have discussed before you start investing. And we'll continue to discuss about the different financial entities that are available in market and where you can invest in. So I try to take some of the important entities into our discussion, be it fixed deposit, recurring deposit, gold, real estate, equity, mutual funds, and we'll try to understand in detail about each entity, and also we'll compare the returns that it generates over the period of time. All right. All right. Now let's get started with first financial entity that most of us are aware, and that is savings account. So friends, when we open an account with a bank, so we know that it's a savings account. But till today, many of us have a confusion that what is savings account and what is current account. So let me tell you the difference. So savings account is mainly for retail people like you and me, whereas a current account is for business purposes where heavy transactions are involved. In savings account, we cannot do transactions above the limit, and the banks offers certain interest rates on savings account, whereas there will not be any interest rate on current accounts. All right. So let's try to understand some of the important things about savings account. Okay. So friends, the main purpose of savings account is to manage your funds whenever you want money to buy something. So for all the expenses and even for the investment purposes, you can just keep your money in savings account. Okay. So it just manages your funds safely. And the next important thing is many of us doesn't know that savings account even offer interest rates. Okay. But yes, savings account do offer some interest rate for the retail customers, which ranges between 2.5% to 3.5%, and it is completely variable. Depends on the RBI announcements. Even the bank will change the interest rates on savings account. Okay. And the next important question that arises in our mind is how the interest is calculated on a savings account. So basically the interest is calculated on lowest balance of the day. So which means, so friends, let's assume that at the start of the day, in my account there is 1 lakh balance, and during that day I have withdrawn 30,000, and again on the same day I have deposited the same 30,000 into my account. So overall at the end of the day, my savings account is having same 1 lakh rupees. But if you remember, since I have withdrawn the 30,000, the lowest balance has recorded as 70,000 during the whole day. So on that 70,000, the interest is calculated. Okay. So I hope you understood how the interest is calculated on savings account. Yes, and the most important thing is, so every quarter, whatever the interest that you have got will get added to your account on every quarter. The main advantage that we get with savings account is you can access to your money in a different ways. You can access with checkbook, you can have the ATM cards, and even in net banking, mobile banking. Okay. And the next thing is it is a high secure and where you can have a high liquidity. So the first thing is high security. So what does it mean? Now imagine that if you are having 10 lakhs at your home and you need to be worried about the security of it, right? But the same amount, if you have it in savings account, you don't really need to worry about the security of your money because bank will take care of it. And the next thing is high liquidity. So friends, let me tell you the liquidity meaning in financial world. It is all about whenever you want, you can take it. That is what a liquidity means. Okay. So it is all time available for you to access your own money in all the different ways that we have discussed, like checkbook, ATM cards, and net banking. Okay. Apart from all the advantages that we discussed, there are certain things that we also should keep in our mind when you are keeping more money in your savings account. So let's suppose if the interest per annum that is more than 10,000, then tax is applicable on that amount. Okay. And for senior citizens, the limit is 50,000 per year. And if the interest is more than 50,000 that you are getting on your savings account, so and tax is applicable on the extra amount that you get. Okay. And also one more important thing that one should know is you have to maintain a minimum balance in your account. Otherwise, either your account will get blocked or it will be lapsed. Okay. So in order to maintain your account in active state, you need to maintain at least the minimum balance. So if we doesn't maintain the minimum balance, we will end up paying some penalty to the bank in order to make it again active. All right. Since you don't have any restrictions to access your funds when you have money in your savings account, so the human tendency will be towards spending it. right? In order to limit this, instead of maintaining a huge amount in saving account, so let's maintain only the minimal which is required for expenses. And the most important thing that we should notice here is savings account do offer the interest rate on the amount that you keep in your account. Okay, and it is not fixed interest rate, it is completely variable. And the other important thing is it is a quarterly compounded one. Okay, so it is advisable to keep a minimum balance in savings account instead of a huge amount. All right, so this is about savings account. All right, now let us look at another important financial entity that most of us do aware and most of us do invest in this, that is a fixed deposit and a recurring deposit. So in simple words, it is called as FD and RD. I hope many of us have heard of it. So let's get started discussing some of the important information about FD and RD. Alright, so if you see, the first column refers to the parameter, and the second thing is about fixed deposit, and the third column refers to a recurring deposit. Let's get started discussing one by one parameter. So if you see the deposit type, so when you are investing into FD, you need to invest in a lump sum, okay? And the frequency of recurring deposit is monthly, okay? And the next thing is tenure. What is the time period that we should invest in these entities, okay? If you are choosing fixed deposit, then the minimum tenure is 7 days and the maximum is 10 years. If we see in recurring deposit, the minimum tenure that you should invest is 6 months and the maximum is 10 years. So these FD and RD you can invest in with the banks or even in post offices. And the most important thing is interest rate. Okay, FD offers interest rate somewhere around 5 to 8%. So this completely depends on the banks, friends. Some banks offers less interest rate and some private banks may offer higher interest rates. Okay, and the most important thing is it is compounded quarterly. So whatever the interest that you get on your investment, it is compounded quarterly basis. Okay, and if we look at the interest rates in RD, it ranges somewhere around 4 to 6%. So always the interest rate of a recurring deposit is comparatively less to fixed deposit. Okay, and again this is also same, it is compounded quarterly basis. Okay, and the next thing is renewal option. So friends, let's suppose you invested some lump sum for 5 years. Okay, and after 5 years, is there any option for renewal? Yes. For fixed deposit, you can renewal your deposit again. You can extend the tenure to some as per your desire. Okay. When it comes to recurring deposit, there is no renewal option. So after the maturity period, you can withdraw the corpus that whatever you get at the end of the tenure, and you can reinvest into the recurring deposit on monthly basis. And the interest rate is may not be the same as when you started. Depends on the current situation, the interest rates of recurring deposit may vary. Okay, another important parameter that one should consider when they are investing into FD or RD is safety. So it's completely a risk-free instrument where you don't need to worry about the interest rates and the returns. Okay, so these instruments offers you the returns irrespective of the market behavior. Okay, another important parameter is tax benefit. So when you invest in these instruments, will we get any tax benefit from the government? Yes. So when you invest in FD for a 5-year locking period, then yeah, you are eligible for some tax benefit under ATC section of up to 1.5 lakh. Okay, so FD offers you a tax benefit, whereas RD doesn't offer you any tax benefits. And the next thing is pre-closure. So let's suppose I have invested in FD for 5 years. The question that arises in our mind is, can I withdraw it in the middle? So with the conditions that as given by the banks, yes, you are eligible to withdraw, but you won't get the same benefits as when your investments gets matured. So you will be getting some less interest rates, but you are eligible to pre-close your investment. Okay, and the same even applicable to RD. Many of us, even job holders, do invest in FDs and RDs. So when you have a lump sum, people invest in FD. When a person is a salaried one, if they are not aware of any other financial instruments, then they will simply invest in RD, right, on a monthly basis. If you compare, friends, the interest rate that savings account offers and the interest rate that FD and RD offers, are comparatively high, right? So now you found a better financial instrument where you can invest than savings account, right? We'll be discussing many other instruments where you get even more better returns, and you will be aware of those very shortly. Okay, so that's all about FD and RD. I hope you understood about all these important parameters regarding those. All right, now let's understand some other financial entities. Those are PPF, EPF, and NPS. Let's understand how these entities are abbreviated as. Okay, so EPF means Employee Provident Fund, PPF means People's Provident Fund, and NPS means National Pension Scheme. Okay, so here if you see, the first column refers with the parameters that we are going to understand all these entities. Okay, let's try to understand one by one. So the first thing is, who can invest into EPF? This is only for salaried employees, friends. The name itself says EPF, abbreviated as Employee Provident Fund. So only the salaried people are eligible to contribute to EPF. And PPF, yes, everyone is eligible to invest in PPF scheme. And the next thing is NPS. So even in NPS, everybody is eligible to invest in this NPS scheme. Now let's try to understand the interest rate that offers by these entities. Okay, it is per annum basis. So if we invest into EPF, the interest rate that it offers is around 8.5%. So again, it is variable, depends on the time. Since these entities are maintained by government, so time on time the interest rates will get varied. Okay, so on average basis the interest rate of EPF is around 8.5%, and for PPF it is around 7.1%, and even in NPS it ranges between 6% to 12%, because it depends on tier that you select. Basically in NPS you have tier 1 and tier 2, depends on which you choose, the interest rate even varies. Okay, and the next parameter is how much you can invest towards these entities. Okay, since in EPF it is only for salaried people, it is basically calculated as 12% of their basic plus TA. Okay, so whatever the salary they get, 12% of their basic salary is contributed towards EPF. Okay, and the interest is compounded on annual basis. And in PPF, since everybody is eligible to invest in PPF, the minimum amount could vary from 500 to 1.5 lakhs. All right, and even this is also annual compounded. NPS, the minimum investment starts from 1000 rupees. Now let's understand the frequency, how often you need to invest. Okay, so if you choose EPF, every month you get salary, some part of your salary goes into EPF, that most of us even noticed in our payslips, right? So all the amount whatever you have been contributing towards EPF, you can even see in the EPF site, where you would have got the UAN number, so which is abbreviated as Universal Account Number. With the help of that, you can monitor your contributions towards EPF. Okay, and in PPF, you can contribute monthly or even annually, depends on your wish. Okay, so same thing goes for NPS as well. You can contribute monthly or annually. And the next important thing is how long we need to invest into these entities. So since it is only for employees, till your retirement you are eligible to contribute towards EPF. Okay, and for PPF the tenure is 15 years. And in NPS, the name itself says National Pension Scheme. So you are eligible to contribute till your retirement, which means like till you are 60. And the next important thing that one should know before they start investing into these entities is, will I get any tax benefit if I invest into these components? Yes, you do get tax benefit if we invest into all these entities. And the next thing is safety. So friends, when you invest into EPF, since it is a fixed interest rate, there is no market risk involved into this entity, and the same is applicable even in PPF. There is no market risk involved. And when it comes to NPS, since there are two tiers like tier 1 and tier 2, it completely depends on the asset class where they invest your funds. Okay, so yeah, so you can consider that there is some risk involved, depends on the asset class performance. And the final thing is about a pre-closure. Yes, you can withdraw your amount which you have contributed towards EPF with certain conditions, and the same is applicable to even PPF and NPS. One is eligible to withdraw some of the funds that they have contributed towards these entities. It could be for your health purpose or your children marriage. Okay, so here you could see some better interest rates that these entities are offering for you, right? So this is about EPF, PPF and NPS. I hope you understood about all these parameters. Alright, now let's continue to discuss with some other financial entity. Especially in India, most of us are excited to invest in this entity. So which is nothing but gold. So in every family, we listen from our parents that they are planning to invest in gold, right? So let's understand some of the important parameters that one should consider before investing into gold. Alright. And the first main thing, especially in India, that we consider investment in gold is a safest investment, right? So that this is what we heard from our parents and even from our surroundings. But practically, let's understand what are the pros and cons in it. Okay. So friends, you can invest in gold in the form of jewelry. So this is one common thing that we do in our families. So whenever you have some amount in your savings account, so you just take out that money and buy some jewelry to yourself or for your parents, right? But let's understand what are the advantages if you invest into this physical gold. And so let's suppose I'm investing into jewelry, okay, which means basically some ornaments where there are some other charges which are involved if you are going for jewelries. Okay, so those are referred as making charges. Okay, so depends on complexity of the design that we choose, the making charges are varies. Okay, so usually it ranges from 20 to 25% and sometimes 15%. So depends on the complexity of the design, the making charges are vary. Now let's suppose we bought a jewelry, and at some point of time when you need some money, when you go and sell that same jewelry, you won't get the same money that invested at the very start. Okay, because they will not consider the making charges, and they will consider only the original value of gold, and depends on that they pay you the money. Okay, so here the one of the biggest disadvantages making charges are involved in if you are going for jewelry, right? If your goal is clear that you are investing only for the jewelry purpose, then it is fine. But considering this as an investment, then it's not a better idea to invest in jewelry. Okay. And the next thing is coins and bars. Even you can invest to buy gold in the form of coins and bars. And another thing is one can invest in a non-physical gold. Okay, so most of us are aware to invest only in the form of physical gold, but let's try to understand something new here. That is digital gold, bonds, and even in ETFs. Okay, so these are different forms of investments where you can invest with the same price what the gold is having in the current market. Okay, you can buy the gold in digital form. Okay, there are many banks that offers it, and there are many private organizations where they offer digital gold. Okay, and you can, it is something like buying as your stocks in the equity market. Okay, so there are gold bonds and ETFs where you can invest and get some certain benefits also as well. So let me tell you some of the advantages if you are investing in ETFs or bonds. Okay, so there are no making charges involved, so there are no physical gold that you carry when you invest in these bonds and ETFs. So the banks offers you a bond which is worth of same as the physical gold, but the main advantages that you get here is if you are investing into these bonds and ETFs, so banks offer you, I think banks offer you some interest rate somewhere around 2.5 with the locking period of at least 5 years. And after 5 years, you can avail that interest benefit on the ETFs, and at the same time whatever the price the gold is having at that time, even you can sell your bonds and or ETFs at the current market price of the gold, and you can get the money back. Okay, and also you invest in bonds or ETFs, still you are eligible to get the loans by pledging these bonds and ETFs with the banks. Okay, so long story short, investing in bonds or ETFs is a better option than in physical gold. Okay, and the most important thing is you can hedge your portfolio by investing some portion of your money into gold. So let me explain this point in simpler way. So let's suppose I'm investing into equity market, and so you might have noticed the cases where if the stock market falls, the prices of gold get raised, right? So when you invest some portion of your funds into gold, it helps to hedge your investments that are there in equity market, and ultimately you can run your portfolio in a balanced way, right? One more important thing is liquidity. So friends, if there is any need of money, and if you are having the gold, depends on the current market price of gold, you can sell the gold into a market. And the last thing is you don't need to have any specialized knowledge to invest in gold, right? So even a common man who doesn't know anything about investments also can invest in gold. In simple, if one really wants to invest in gold, investing in bonds or ETFs is far better option than investing in physical gold. Okay, but if you analyze, there are many benefits that you can avail if you invest in ETFs and bonds. So this is about some important information about one more entity, that is gold. Okay, now let's understand one of the most important financial entity that most of us do ignore, and that is mutual funds. Okay, so we have been talking about the term called risk. Now here you will understand what actually it means. Okay, so let's try to understand some of the important things about the mutual funds. So these mutual funds are maintained by some of the AMCs. Instead of you directly investing into stocks of the companies, so you invest into some fund house where that AMCs collects funds from the retailers like you and me, and that huge amount they will be investing into stocks, because the AMCs are maintained by high professionals. Okay, so every AMCs has experts in it, and they are experts in uh, choosing the right stocks to invest. And the next thing is the compounding that you get when you invest into mutual funds. All right, we have seen other instruments before where you have seen the compounding was quarterly and compounding was done annual basis, right? But here the compounding is done on every day. So whatever the profits you get today will get added for tomorrow's. So here you have the magic of compounding, and this instrument can give a better returns compared to the previous whatever entities that we have discussed. And the next thing is, how can we invest? Do we need to invest into a lump sum or any other? So you can choose investing into mutual funds in SIP mode or even in lump sum. So if you are a salaried person, if you want to contribute some part of your savings into mutual funds on a systematic way, then you can choose SIP mode. If you are having some lump sum amount with you, and if you are willing to invest into a stock market, if you are not much aware of selecting the right stocks, then you can happily invest in mutual funds and they will take care of your funds. Okay, and the next important thing is diversification. So friends, we are aware that mutual funds are involved directly with the stock market. So the company performance will depends on lots of factors, right? It depends on the global news, it depends on the company news and many other things, right? So instead of putting all the eggs in one basket, so the mutual funds will diversify your investments into different sectors and different stocks, so that even if the market is so volatile, but your portfolio will be in a more balanced way, since the investments are diversified. And the next thing is liquidity, where you invest into mutual funds and whenever you want you can withdraw your investment. All right, depends on the type of mutual fund you invest, You can withdraw whenever you want. And the next important thing is, so certainly, compared to the other previous entities, mutual funds will give better returns, because if you look at the historical returns of all the instruments, so mutual funds stands at a better place in terms of generating better returns. Okay. And the next thing is, do we get any tax benefit if we invest in mutual funds? Yes, we do get, but provided you should select the mutual funds which comes under ELSS scheme, which has 3-year lock-in period to it. Okay. And the next important thing is, what is the minimum investment that I can do in mutual funds? Okay. So it starts with a minimum of 500. So you can select the mutual fund whatever you want, and you can start investing into it. Okay. And the last important thing that one should aware is, so mutual funds are no fixed return instruments, and it completely depends on the market risk, because your funds are directly gets deployed into the company stocks, depends on the performance of the companies and depends on the market condition. So return gets varied. As per the historical data, mutual funds generates a better returns than any other asset classes, that whatever we have discussed so far. So one can start analyzing about mutual funds, because most of us, even employees, do not aware the importance of mutual funds. They go and invest into RD or FD. Okay. If you are young, then I do suggest that as early as possible you start investing into mutual funds than fixed deposit or recurring deposit or PPF or NPS. Okay. So try to contribute some amount of your savings into this fund, because in long run the amount of return that you get from mutual funds is quite different from other financial entities. Okay. All right, now let's start discussing about one of the financial entity that one needs to know about is equity market. Many of us hear that investing into a stock market is very complicated and it's very risky. Okay, so without taking any risk in investment, we cannot definitely expect high returns, right? Anyway, so let's get started discussing some of the important points regarding the equity. All right. So when you invest into a company stock, so definitely you become the partial owner of that company. Okay. Let's suppose if I buy 2 shares of Reliance, then I become the partial owner of Reliance, right? Because I'm holding 2 shares of the company. So when you hold a company share, you become the partial owner of that company, right? And the next thing is, how can you invest into equity market? You need to open a DEMAT account. There are many brokers in the market where you can open the DEMAT account with them, and you can start investing into company stocks. Okay, so the brokers provide you the platform where you can select the stocks and invest in them. All right. And the most important thing is, friends, you need to do an extensive research on stock analysis before investing, right? Because it is not an instrument where you get a fixed returns or government is going to take care of the investment. No, it's completely depends on your analysis, because there are many companies in the market where you are selecting a few stocks and you are investing on them. For that, you need to select the best stocks. Depends on the risk that you are willing to take. And the next thing is, and the most attractive thing for investments in equity market is magic of compounding. Because so the returns that you are getting here in equity market are compounded on a daily basis. Okay, so that makes you get a higher returns in short period of time. Okay, so along with this, there are other benefits that you get in equity market. So along with the capital appreciation, you also eligible to get the dividends. So there are companies in market which offers high dividends to their shareholders, and there are companies who takes their profit and they reinvest in the company growth. Okay, so it depends on the company vision. All right, and the next important thing is high liquidity. So friends, whenever you want, you can buy the stock, and at the same time, whenever you want, you can even sell the stock. So this term liquidity applies depends on the stock that we select. Let's suppose if I'm taking large cap companies, So in large cap companies like HDFC, Reliance, TCS, so all of these companies have a high liquidity where you can sell at any point of time whenever you want. Okay. At the same time, if you choose some companies where there is a low liquidity, okay, it is a bit risky to invest into those kind of stocks where the liquidity is less compared to the large cap stocks. And the next important thing is, definitely, since it needs lots of analysis from one before investing into the stocks, it definitely generates higher returns compared to the other financial entities. And even in the very short period of time, you can make higher returns in the equity market. Okay, so there are many people who have proven that you can generate higher returns in equity market in very less period of time. And definitely, since it gives higher returns, and there is a important thing that we can't avoid is risk is involved. Okay, so one should be very careful before investing in their hard-earned money into a stock market, because this is some instrument where a high risk is involved. You do your own research, you do your own analysis, and select some best stocks, and then you invest into the market. Even if you lose, that's fine. You get some experience, you learn, but never ever go with the third party tips. All right. So this is all about equity market. So along with the equity market, there are other markets like commodity market and currency market, also derivative market, where one can invest and generate returns. Okay. But friends, long story short, equity markets are something where a risk is involved. At the same time, it generates a higher returns compared to the other financial entities. But definitely, you need to do a bit more research on the stock selection, understanding the company fundamentals, understanding the technicals to know the right entry and to know the right exit. So definitely, you need to know some specialized knowledge to invest into this equity market. All right, now let's understand the other financial entity, which is real estate, and most of us are familiar with this term real estate. So let's start understanding some of the important parameters before you invest into real estate. Okay, so basically, investment into a real estate is means that you are owning a property. Okay, be it a land or be it a home or something. Okay, and second thing is, investment into real estate is comparatively less risk, and it generates good returns in the longer term. Okay, so one should have a clear analysis and clear vision towards their investment so that they can generate good returns in a longer tenure. And the third thing is, when you invest into real estate, yes, you do get some tax benefits where you can avail. Okay. And the next thing is, you need to do a lot of research. You need to roam around the places. You need to understand the area very well. Okay. Before you invest into real estate, because there are a lot of other factors which can impact the price of the land or the building. So you need to be physically go there and do the research and analysis, and you need to be more cautious in selecting the right place to invest in real estate. And the next thing is, there is a chance that you may get into conflicts because this real estate involves lots of gambling. There are many false registrations that we heard in market, that usually there is a chance of getting conflicts in this business. Okay, a big concern to invest into real estate is one needs to have a more capital to invest. Okay, it's not like other entities that we discussed earlier where you can invest with 1,000 or 10,000. So at least you need to have lakhs to start investing in a real estate. Okay, and the other thing is where you need to take care of other expenses in this business, right? So it could be the broker charges. You need to take the help of a broker to find the right place to get. And also there are some registration charges you need to pay when you are buying any plot or building. Okay. And the main concern when it comes to the real estate business is liquidity factor. So friends, whenever you are in need of money, okay, but you are holding some plot or some apartment, some building, you can't sell at the time when you need the money, right? Usually it is a time consuming process to find the right buyer, where you can say that there is a less liquidity, right? This is a more concern when you have a surplus amount of money where you don't need to worry about the money that you deployed into real estate, then it's fine. But otherwise, whenever you want money, you may not get at the right time. Otherwise, you need to sell at the a cheaper price to get the money. Okay. So one is to take care of this liquidity factor before they invest into real estate. Okay. So on the whole, real estate is one best option if your vision is for at least 5-10 years. But for short-term investment, if you are having a less amount and if you are deploying all your 100% capital into real estate, that may not be the best option because it has a less liquidity. Even if the market gets stagnant, your capital gets blocked into that business and you cannot take out whenever you want. Okay. So consider all these factors before investing into this business called real estate. Okay. So I hope you understood about this. Alright, so far we have understood the different types of financial instruments that are available in market, and also we have discussed all the parameters that one should take into consideration before investing into those instruments. Okay, so I have taken some of the financial instruments here just to analyze the amount of return that it can generate over the period of time. Okay, so if you see here, I have taken RD since it is a fixed income instrument that RD can generate 6% per year. Okay, so similarly PPF I have taken 8% approximately, and if you can see here NPS depends on the asset class again. I have taken average return that it could generate somewhere around 9.5% per year. Okay, and here is one more important instrument, that is mutual funds. Depends on the historical data, it has given somewhere around close to 13% returns in a year. Okay, and similarly if you take equity, considering that you may be a trader or investor, so on an average basis if one could generate 18% return over the year. Okay, so we will see how the returns will be in a long term. Okay, so imagine friends, uh, if I'm able to invest 5,000 in any of these instruments like RD, PPF, NPS, or mutual fund, or even equity. Okay, so if you are investing monthly 5,000, so yearly you will be investing 60,000, correct? So we will see if I'm investing 60,000 into RD, how the returns will be. Okay, and similarly in other securities as well. All right, we'll see the result how it will be generated over the 30-year period of time. Okay, so if you see this column refers to year, on the first year you are investing 60,000 and with 6% interest rate, and the amount of interest that you get at the end of year is somewhere around 3,600. Okay, it gets added to the initial investment, so the total will become as 63,600 rupees. And in the next year, okay, so after completion of 2 years, the interest will get calculated on 60,000 plus 63,600. Okay, so here we are using annual compounding, where the previous year return will get added to the next year in a new investment. Okay, so which means in second year your total investment will be 60,000 plus 63,600, correct? And at the end of second year, this is the amount that you're going to generate if you invest in RD. So similarly, if you can see here the other securities at the end of second year, you can see here in RD it gives somewhere around 1,31,000, right? And in PPF it gives around 1,34,000, and in NPS it gives around 1,37,000, and in mutual fund it gives you around 1,44,000, and in equity it gives around 1,54,000. So I have just roughly applied annual compounding on all these securities. Okay, so considering that every month you invest for continuous period of 30 years, and we'll see how the returns will be at the end of 30 years. Okay, so friends, if you could notice, this column refers to RD. If you keep investing into RD for 30-year period of time, then this is the amount of return that you're going to get. Okay, it is somewhere around 50,28,000. Okay, and the same thing if you notice in PPF, it is somewhere around 73 lakhs 40,000. And if you see in NPS, it gives you somewhere around close to 1 crore. And if you see the mutual fund return, it generates close to 2 crores at the end of uh, 30th year. Okay. And if you could see in equity segment, if you are investing for the continuous period of 30 years, it is a remarkable return which is close to 5.5 crores. Okay. So this is some amazing returns that you could see, right? The same 60,000 you invested in RD and the same 60,000 you invested in equity segment. But could you see the difference, friends? In RD, it just gave you 50 lakh, whereas in equity segment, it has given you somewhere around 5.5 crore. Okay. I hope you understood the power of compounding that lies in investment. Okay. Now quickly take a look on a graph so that it will be a clear for you to look at the amount of returns that these instruments can generate over 30-year period of time. Okay, all right. The x-axis you could see here, which is having 30 units, so it means 30 years, and the y-axis indicates the amount of return that you generate at the end of 30 years. So friends, here which line indicates what you could see here, I have clearly mentioned. Okay, so the green one indicates equity and the yellow one indicates the mutual fund return and the gray line indicates NPS return and this indicates a PPF return, and at last a red indicates RD returns. Okay, so here if you clearly notice friends, the first 15-year return for all the securities is almost close, right? If you could see, even the equity also gave a return of around somewhere 50 lakh in the first 15 years, right? Whereas if you see the next 15 years, the graph has gone exponentially, right? And same goes with the other instruments as well. Okay, so this is what the magic of compounding, friends. Okay, so the long you keep investing, the greater returns that you can generate. Okay, since we have taken investment for 30-year period of time, let's suppose you start investment at when you are at the age of 25 and you have to invest until you become 55, right? And at the end of 30 years, this is what the amount of return that you can generate. Okay, so if you see at the end of 30 years where the RD return stands, where the PPF return stands, where the NPS and where this even mutual fund stands at. Okay, so this is what the magic of compounding, which makes the investments can grow like anything. So if you are young and if you are able to take enough risk, then at least you can start investing into mutual funds. Okay, so once you get some experience in understanding the market, in understanding about the sectors, all of that, then you can think of investing into equity. Okay, so some of them may also think that okay, since equity gives some amazing result over the period of time, one can happily choose investment in equity, but that may not be a choice, friends. Okay, to understand this, let me give a simple analogy here. Okay, so let's suppose most of you know about the cricket. If you are investing all your 100% savings into equity, okay, it is something like all the players in a team are like a Chris Gale. So Chris Gale has the ability to break the records with his adventurous batting. But do you think this is the best option to have all the 11 members in a team like a Chris Gale, friends? No, right? So this is something like a risk investments. Now let's look at some other team where the team is so balanced that the team is composed of hitters, all-rounders and good bowlers. And it is something like, and in our financial investment terminology, you can think of like a balanced portfolio. Okay. So as much as you diversify your investments, it could be into real estate or it could be into equity and some portion of money into for retirement saving scheme. It's always better to diversify your investments so that your financial life will be in a more balanced life. Okay, so I hope you understood about the importance of diversification in investment. And at last, friends, I would like to conclude this video with one quote which actually made me to think in a different way, and that is, biggest risk in life is not taking any risk, friends. It doesn't mean that you should take 100% risk, but you should always take a calculative risk when it comes to financial matters. Okay, so I hope you understood about the importance of investment at the early age, friends. Okay, so I'm coding it again, at the early age. So don't waste your young life. Do research on these instruments and try to start your investments at the early age. Okay, so all the best, friends. Thank you so much for watching this video.